guys, if you cannot tell me why this move happened with a reasonable degree of confidence, just this whole move here on Aussie JPY, then how on earth do you expect to protect yourself against when this happens, next time? If you're trying to counter the trend, for example, which is a strategy that can work, it's a strategy that we employ where we, basically do mean reversion. If you're just buying, 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 and losing throughout this whole period, this can completely destroy a trading strategy's performance, all because you didn't know how to do it or were too lazy to do it. Now, in order to do this, we do need to understand some fundamentals. But in this video, before you start getting bored, I want to ask you, why would you not expose yourself to something that could have an impact on your trading? People say, oh, fundamentals bore me. They kind of bore me as well. But at the end of the day, it's like, do you want to be a successful trader, or do you just want to be a really comfortable trader? And by comfortable, I mean you're really happy with, your little process and it fits your personality. You need to do things sometimes that are a little bit outside of your comfort zone. Anyway, rant over. How do we do this? Let's break it down into some simple terms for you. What are the big things? And I'll give you an example of each. Monetary policy and interest rates. Basically, what the central bank says. Now, I'll give you an example. If we compare this currency here, Aussie, ignore my slow writing, we have Aussie, we have JPY. What is significant about Aussie JPY? Well, let's just say, and I'm pulling these numbers out of thin air, by the way, the interest rate, and this is true, the Aussie has had a much higher interest rate than the Japanese yen for quite a while. Japanese yen typically always has one of the lowest, if not the lowest, interest rate. But let's just say that the Aussie dollar had an interest rate of 10%, and this was 1%. It's not normally measured exactly like this, but anyway, 10% and 1%. So if you are an investor looking to put your money somewhere, are you going to be more attracted to a 10% gain on your money or a 1% gain? Obviously, it's going to be 10% every single day of the week, which means that when this happens, when these differences between interest rates occur, money is going to more likely than not flow into the Aussie JPY. People are going to start buying it. And that, because currencies come in pairs, when you buy Aussie JPY, you're also selling JPY, right? And so when this rate is higher, it's going to attract more money to the currency. Now, there is another layer on top of this as well, because we have the actual difference, which is great. So we'll mark this as number one. But then what about number two? What's the second filter as an example of what to look at? Well, is this growing? Is this gap between these growing, or is it declining? Because what would often happen, and I'm just going to use a random point in the past just to illustrate this. Let's just say that around about this point here, okay, the interest rates started growing. The differences between the two started growing, right? Specifically, let's just say at this point, we were looking at 5% for Aussie versus the same 1% versus the yen. So I'll just do an A for AUD and then a J for JPY right here. Okay. Now at this point, let's just say from down here all the way to, let's just say up here, we go from 5% to 1% to what we said in our example, 10% to 1%. Now, this is in fact, let's just maybe move this across just slightly. This means this is a big, big, big influencer, because we can see that gap is growing. The difference between these is growing, and therefore, let's just say prices are going up, and that is a major reason for it. Now, if there is, let's just say, an announcement, a central bank, okay, and this is part of the reason for the dump here, from my analysis anyway, around here, the Japanese, okay, central bank, I didn't mean to do that, but let's just move this here. Let's just say there was an announcement there, okay, and this did happen. These numbers are wrong, but the Japanese central bank did say the following, and I'm not quoting them. They said that they were looking, or there was a possibility that they were going to increase their interest rate. Now, they haven't increased their interest rate, but they put it out there that they are quite hawkish, meaning they're quite basically, bullish towards increasing their interest rate. So what that means is investors were now going, okay, well, we've had this for a long time, but maybe very, very soon in the future, there's been a clue that maybe somewhere down the road, maybe around about, over here, Aussie can still, let's just say, maintain everything the same at 10%, but maybe the Japanese yen interest rate will go to 2%. Now, that difference doesn't seem that much, really, because even compared to over here, we had a 5% difference to a 1% difference. And over here, we're 10 times bigger. So going back here, we're still 5 times bigger, which is the same as we had over here. So why would this have such a huge impact? Well, because people and investors are always looking to minimize their exposure to risk. The markets are risky places, right? And so when we hear about announcements like that, all the people who were in these trades, and by the way, people who trade the difference between interest rates, it's typically called the carry trade, right? All of those people are now moving money out of the Aussie, right? They're moving it out and into the JPY, okay? This is part of the reason why prices now begin to flush, and they begin to flush quickly. Then you've got sentiment on top of that and other things as well. So this is the first thing to understand, right? It's like markets are trying to price in not just the information, but the expected change, like the relationship between that information. So to split this into two things, and I'll just categorize it here, we have the difference and the difference trend. So we have the difference between the interest rates, 10%, 1%, and we have how that difference is changing over time. Is it shrinking or is it growing? That's step one. Number two is going to be just the basics, the economic fundamentals. You don't really need to understand this deeply to be able to do it. We're very lucky with ChatGPT and other tools nowadays, right? Finding simple arguments for pro and against. All we're really looking for is are the economies strong? Is one significantly stronger than the other? That's really it. Now, if you don't understand how to do that, just do the following. Go to FX Street. There are loads of websites that do this. Go to analysis, pick your currency pair, scroll down to here where we have the big picture, and you'll see that we have Euro bullish themes, Euro bearish themes, USD bearish themes, and USD bullish themes. Now, you can see that there's lots of arguments on both sides. There's lots of bullish arguments. There's lots of bearish arguments for the same currency. Now, even if you don't understand this, copying and pasting it into ChatGPT will give you an idea, and it will simplify it as to which may be stronger to see if there's a significant imbalance. ChatGPT can be a little bit of a problem sometimes. Like you can type in, for example, if I have one ChatGPT tab and a second one, and in the first one I ask the exact same question, so question one, and then ask the exact same question in question two, both can give me opposite answers. I've done this before. I've copied and pasted this. These arguments, the exact same arguments, ask the exact same question to just two different versions of ChatGPT. One says that Euro is stronger. One says that USD is stronger. How the hell is that possible? And so in order to fix that problem or minimize that problem, we then need to put this through just one of these, not both. We need to put it through a filter of specific questions. And this is what we can do through a checklist. So this is something that I'm revealing to the members in our Discord, a more comprehensive checklist. But I'm still going to give you all the categories and give you a breakdown of the types of questions I'm going to be asking here as well, because you can connect the dots if you want to as well, just to make things simpler for the members. That's it, really. But we're just kind of applying a filter, and in this case the filter and the answer that we'll be trying to get is, which is one economy significantly stronger than the other, is one weaker? Because, for example, you could have, this scenario here, we've got a 10% interest rate on Aussie JPY, and it's growing on Aussie and it's staying the same on JPY, which is really, really good. But then the Australian economy is getting massively weaker and the Japanese economy is getting stronger. This is where we start edging into, out of the points that I'm going to give you, you're going to need to make an assessment as to which one of these holds more weight, which one is more important. Is it more important that the economy is getting stronger and this one's getting weaker, or is it more important that the interest rates are changing? What are people going to pay more attention to? This is another thing that I might discuss it a little bit towards the end of this video, but this is another thing that you can add into a checklist, and then as a follow-on step, as a further filter. So let's just say that this gives us 0.2. And then as a further filter from 0.2 into 0.3, we can then look for and ask ChatGPT for an assessment based on all of the information we've gathered through the checklist and be like, look, out of all of these points, which do you think is most important and why? And that can give us a bias for what we might be expecting from price guys, right? Without actually doing much of the heavy lifting at all, right? So number three, and by the way, for economic fundamentals, the main things are going to be like GDP, right? The gross domestic product, inflation, employment data, trade balance, a little bit of fiscal policy, things like, tax policies and stuff like that. That's really it. Remember, most people are just looking at it in terms of risk. That's all they're really looking at, right? They're going, look, are we getting significantly weaker? Okay, it's mostly geared towards one getting weaker rather than the other necessarily getting stronger most of the time. Anyway, number three, political and geopolitical stability. Now, this is my least favorite. I absolutely hate politics. I think it's, ridiculous on so many levels. But this is mostly from a standpoint of looking for uncertainty, right? And this is going to be a theme throughout: uncertainty. People don't want to have their money on the line during uncertain times. It's like, would I feel really comfortable putting my life savings on a roulette wheel? No, of course not. Because it's uncertain. And so in the exact same way, if there's political uncertainty, you have to take that into account for, when analyzing whether investors are going to be looking more towards one direction or the other. Number four, large transaction events. So these need to be quite large to be valid. And these are ones that aren't spoken about as much. So what the hell is a large transaction event? Well, let's, for example, imagine that you have the acquisition. In fact, I'm just going to write it, not embarrass myself. Acquisition of a foreign company. So let's just say that a Japanese company is acquiring a big Aussie company, meaning they're going to buy out that Aussie company. Now, in order for them to buy it, let's just say they're buying it for $10 billion, right? 10 billion, big number. In order for them to do that, they're going to need to sell JPY and exchange it for Aussie dollar. Now, what does this mean? Well, it means that this is going to have an impact on the market in some way or another. Now, of course, the bigger the transaction, or usually multiple transactions, the bigger the effect is going to be. This is just something to be aware of. This is normally just going to cause, spikes in volatility and things like this, right? But it's not just this, because there are other transactions as well. Central banks will sell off or buy up their own or each other's currencies. Again, for the exact same reason as before, normally, which is either going to be price stability or portfolio, meaning just a basket of things that they are invested in, portfolio risk aversion, meaning they want to be as risk averse. They want to keep away from as much risk as possible. There are some other reasons like market stability and things like this, which is a little different to price stability in my opinion. But these are just a few examples. There are loads of things. There's central bank interventions, corporate I don't know how to pronounce that. Repatriation. I don't know. It's one of those words. Anyway, there's loads of things as well. Portfolio investment flows, things like this. But this is something that again needs to be considered. 5. Market sentiment. Speculation. So this is where most of us spend all of our time anyway. Sentiment is going to be very visible in price. Price is a slightly lagging indicator of sentiment. But for example, let's just say you didn't do any of the things that we've been talking about here, and you see price aggressively start moving down. You don't need to be a genius to figure out that the current sentiment is declining on Aussie JPY. Like, you don't need to be a genius to figure out at this point now that the sentiment for the Aussie is declining in comparison to the JPY. It doesn't take an absolute genius, right? However, it's important to understand this and look at it from a level of risk appetite. So again, risk on, risk off. Another way of saying, are we in an environment where investors are willing to take on a little bit more risk or a little bit less risk? So there will be prevailing trends. You've got the trend of the current sentiment, and then the next layer is going to be risk on, risk off assets. Are we on a risk on period or risk off? Simple way to look at this, right? If it's during what you consider to be a more risky period, and how do you define a risky period? Well, it could be a blend of all of the above. Okay, a blend of all the above, because these are all going to be the big things that cause anything. When you see uncertainty, weakness, big differences between two of these things, like these sorts of things, the more of them that there are, the more extreme they are, the more risky that environment is. And people are always trying to move away from risk most of the time. But during high risk periods where people are willing to take more risk, when they're feeling more confident, they're going to move to more traditionally risky assets. So they're going to move away from like safe haven currencies like the US dollar, like the Swiss franc, like JPY. They're going to move towards risk off currencies. Sorry, to risk on currencies like more exotic ones and stuff like this. And so understanding this is going to give you a good insight. Now, how can you gauge this? You're going to get a pretty good idea of this just by doing these previous things and just understanding these and asking simple questions for each. And by the way, you can narrow most of these down to 2 to 4 questions for each one of these things, and then just input that checklist into ChatGPT and then feed it information and ask it to answer the questions in the checklist according to that. And then number 6 is going to be technicals. Good old technicals. It's just that final confirmation. When you have a bias as what you think is more likely to happen, it just gives you more confidence, and then you can apply a technical thing to it. If you are saying, look, I think the market's going to go down, then I'm going to be more open to rejection signals or whatever the hell your strategy is. Okay. And so, guys, these are the big things. I don't see many people talking about transaction events in particular. But yeah, there's at the end of the day, we're looking for differences between these. We're looking for extreme problems and expectations of these things changing. You don't need to be a genius. You don't need to forecast everything perfectly. You can do it with a simple checklist. You can do it with simply looking at, look, what is slightly more likely than the other. It's just a basis to build off of an existing technical system. It doesn't mean changing a system. It just means being able to pick the right environment, maybe being able to pick the direction more often. And that's really what it's all about. I know this video is probably really, really boring for most of you, and I get it. I've mostly been a technical trader for the longest time, but yeah, I don't know. I just quite like having an idea of what's going on because it makes me feel like I'm more in control than I did before, which for me is really psychologically soothing. And by the way, I can do this in really little time, like 30 minutes a day, maybe even less than that, maybe even 30 minutes every few days. Um, and the easiest way to start with this is just to start with one currency pair, not multiple, just start with one master, one currency pair's fundamentals, and you'll learn it really, really quickly. And as always, even if you predict things fundamentally, you're still going to be wrong a percentage of the time. It's not like, oh, I learned fundamentals and therefore I'm, an expert and I just get it right every time. It's the same as price. Like you wouldn't expect a strategy to work every time. It's about probabilities. Same thing applies to fundamentals. But when we have technical probabilities on our side and fundamental probabilities on our side, then the goal is just to have our overall probabilities go up, right? And so in other words, it's just confluence. But yeah, so I hope that you have found this helpful. If you would like a couple of ideas of strategies to go with it, I'll leave a video right here on the end screen here so that you can go ahead and check that out. And yeah, hope you have an amazing rest of your day. Take care. See you later.